Imagine it is Friday night. You are tired. You open your phone. A few taps later, dinner is on the way. Maybe it is a burger, sushi, pasta, wings, something quick. The food arrives, you eat, and the night moves on. The order feels small, maybe $30. Maybe a little more after delivery fees, service fees, taxes, and tip. And because it happens only once a week, it barely feels like a financial decision. It feels like convenience. It feels like comfort. It feels normal. Now imagine there are two versions of the same person, same age, same income, same job, same apartment, same life. The only difference is what happens with that one weekly Uber Eats order. One version orders delivery every week for 20 years. The other version invests that same amount every week for 20 years. At first, the difference is invisible. After 1 week, it is just dinner. After 1 month, it still feels small. After 1 year, the difference starts to show. After 20 years, the gap can become shocking. So let's break it down in the simplest way possible. Let's say one Uber Eats order costs $30. That is conservative for many people. A meal might start at $15 or $20. Then the total grows once delivery fees, service fees, tax, and tip appear at checkout. That is one of the strange things about food delivery. You think you are ordering a $20 meal, and then the final number looks closer to $30. Now, $30 once is just $30. $30 every week is a pattern. There are 52 weeks in a year. So $30 a week becomes $1,560 a year. Over 10 years, that is $15,600. Over 20 years, that is $31,200. That is before investing. That is just the raw money spent. And this is the first twist. A weekly habit can feel small while it is happening, yet become massive when you zoom out. Most people do the opposite. They judge money by how it feels in the moment. $30 does not feel like a future-changing amount. It feels like dinner. It feels like something you can forget by tomorrow. And that is exactly why recurring spending is so powerful. The smaller it feels, the easier it is to repeat. Now let's look at the second version of the person. Instead of spending that $30 every week on delivery, they invest it. Same amount, same schedule. Every week, $30 goes into a simple, long-term investment account. For the first month, it is boring. After 4 weeks, they have invested about $120. That does not feel impressive. After 1 year, they have invested $1,560. Now it is real, though still modest. After 5 years, they have contributed $7,800. That already sounds different. At 10 years, they have contributed $15,600. At 20 years, they have contributed the same $31,200 the first person spent on delivery. Same cash flow, different direction. One person turned it into meals, the other turned it into assets. Now here is where compounding changes the story. If that $30 a week was invested for 20 years and earned an average return of around 7% per year over the long term, it could grow to roughly $66,000. That is the part most people miss. The person did not invest $66,000. They invested about $31,000. The rest came from time, growth, and compounding. This does not mean the market gives you 7% every year. Some years are great, some years are painful. Some years the account may drop even while you are doing the right thing. Markets move unevenly. The example is a simple long-term illustration, not a promise, but it shows something important. The real cost of a weekly habit is not always the price you pay today. Sometimes it is the future value of the money you never invested. And this is where the Uber Eats comparison becomes interesting. Because the problem is not food delivery itself. Ordering takeout does not make someone bad with money. Enjoying convenience does not mean someone is irresponsible. The real question is whether your future gets a weekly payment too. If Uber Eats gets paid every week, Netflix gets paid every month, the phone company gets paid, the landlord gets paid, the car company gets paid, and your future gets whatever is left over, your future is last in line. And whatever is last in line often gets nothing. That is the quiet trap. A lot of people do earn enough to build something. They just never give their future a recurring slot. Everything else becomes automatic. Their wealth stays optional, and optional money usually disappears. Now let's make the comparison even clearer. If the Uber Eats order is $20 a week, That is $20,800 spent over 20 years. Invested at a 7% average return, it could become roughly $44,000. If the order is $30 a week, that is $31,200 spent. Invested, it could become roughly $66,000. If the order is $50 a week, that is $52,000 spent. Invested, it could become around $110,000. That is one order a week, one decision repeated. And this is why small money choices matter so much. People often wait for a huge financial moment, a giant raise, a perfect investment, a sudden breakthrough, a year where everything finally feels easy. Meanwhile, their actual financial future is being shaped by ordinary habits. What happens every Friday? What happens every payday? What happens when they are tired? What happens when they are stressed? What happens when the app is already on the phone and the card is already saved? Convenience is designed to remove friction. That is why it works. You do not feel the money leaving because the process is so smooth. No cash leaves your hand. No envelope gets lighter. No physical reminder appears. Just a button, a confirmation screen, and a charge on your card. And this matters because friction changes behavior. If you had to take $30 in cash, walk outside, and hand it to someone every time you wanted delivery, you might think about it differently. But when the payment is hidden behind a tap, the spending feels less real. That is one of the biggest changes in modern money. Spending has become easier to do and harder to feel. Investing has to compete with that. That is why automation is so useful. If you have to decide every week whether to invest, you may skip it. If the money moves automatically, the decision is already made. Your future gets paid before the week starts negotiating with you, and the amount does not have to be huge. The point of this example is not that everyone should delete every delivery app and never order takeout again. The point is that the same recurring power can work in your favor. $30 a week spent disappears. $30 a week invested can become a financial base. And once you understand that, you start seeing recurring money differently. A weekly delivery habit, a few unused subscriptions, a lunch upgrade, a random online purchase, a convenience fee. Alone, each one seems harmless. Together, they can become the difference between having nothing invested and having tens of thousands of dollars working for you. That does not mean life should become joyless. Money is also for living. A meal with friends matters, rest matters. Convenience can be worth paying for, but when every comfort is funded and no future asset is funded, the balance is off. A strong money system does not require you to hate spending, it requires you to choose which spending gets to repeat, because repetition is the real force. A single Uber Eats order will not destroy your finances. A single investment will not make you wealthy. The repeated version of either one can change the path. That is the lesson. The weekly order is visible for one night. The weekly investment is almost invisible for years. Then, one day, the invisible thing becomes the bigger thing. The account crosses 10,000, then 20,000, then 50,000, then maybe more. And the strange part is that it may have started with the same amount of money that used to disappear into one tired Friday evening. So what would happen if you chose investing instead of Uber Eats every week for 20 years? If the weekly amount was $30, you might avoid spending $31,000 on delivery. You might build an investment account worth around $66,000, depending on returns and real-world conditions. If the habit was closer to $50 a week, the long-term difference could move towards six figures, and beyond the number, something else changes. You become the kind of person who gives small money a serious job. You stop seeing $30 as meaningless. You start seeing it as a seed, small enough to ignore, powerful enough to grow. That is the real difference after 20 years. One path gives you the memory of convenient meals. The other path gives you an asset. And the most interesting part is that the path does not have to be extreme. You could still order sometimes. You could still enjoy life. You could simply decide that your future deserves the same consistency as your favorite app. Because if a company can collect money from you every week for 20 years, your future can too. For education only. This is not financial advice.